Hello, welcome back. Today's video on business taxation is still on corporation tax, and we are still dealing with the basics, taxable income. We are here still at the beginning, so we still have much to do. And today's topics will be dividends and shares. How are they treated under corporation tax law in Germany? We talk about dividends received only, so not about the dividends which a corporation pays out to its own shareholders. Here our topic is the dividends which it receives from investment in other companies. For example, if they have a subsidiary company in which they hold shares and get dividends from it. There is a very simple rule on that. Under German tax law, a dividend which is paid by one juridical person to another one is tax-free in the hands of the recipient. That can be seen in paragraph 8b, section 1 KStG. So just in order to be sure, let's have a look on that. Well, here it is, 8b1 KStG, first sentence. Income in the sense of paragraph 21, numbers 1, 2, 9 and 10, and that is put in plain words, dividends mainly, of the ESTG remains unconsidered. Here you see how hard it can be for a member of the fiscal administration if they have to draw up the wording of a law to cope with that brutal word tax-free. So whoever wrote that text wanted to avoid unconsciously or subconsciously that brutal word tax-free. So he or she tried to explain it differently. It remains unconsidered. So it's not taken into account. It's not entered into the calculation. So plain and simple, it's tax-free during the computation of the income. This is the decisive sentence here. And let's go back to our slides. And again, we can go on with that because here we have now a very hard restriction for that tax exemption. That tax exemption is only granted if the parent company holds at least a participation of 10% at the beginning of the year in that lower company. So percentage must be given at the beginning of the year, or if you later buy a participation, it only qualifies it from the beginning onwards. It's directly at 10% or higher participation. So what they want to avoid by the 10% at the beginning of the year or at the beginning of the purchase rule is that somebody has 9.5% or so in a company, and closely before the dividend is paid out, buys another 2 or 3 shares in the market for 3 days, then says at the moment when the dividend came I had 10%, though it was tax-free, and then sells away these, let's say, 3 or 4 decisive shares afterwards. Again, they only want to privilege a constant participation of 10% or higher. Naturally, as we talk about legal stuff, here a glance into the underlying legislation is again a promising thing. So we are going to have it and have a look into 8b4. And surprise, here it is. Deviating from paragraph 1, so different from what paragraph 1 says, the revenue defined in paragraph 1, that means the tax-free dividends or the dividends, shall be taken into account, so shall be computed, shall be taxable, for the computation of the taxable income if the direct participation has been at the beginning of the calendar year less than 10% of the share capital. Also here you can see people are able to express themselves in a very complicated way, but the message is clear. If you hold less than 10% at the beginning of the year, then that means no tax exemption for the dividends, in the hands of the parent company. The reason for this tax exemption is as follows. One wants to avoid a double taxation within the same group of enterprises, because imagine there is a company somewhere at the bottom in the group, a subsidiary. Then we have natural persons somewhere at the top of the whole organizations being shareholders of the parent company, and we have the lower company paying corporation tax and the final shareholders paying income tax on their dividends. And if you add these two taxes up, then you have corporation tax at the bottom, approximately, let's say 15. And you have income tax of the shareholder might be 25. It's not a complete adequate calculation here due to some effects, which I'm not going to deal with. But in principle, then you have, let's say, in a simplified view, 15 plus 25 total tax burden. This is relatively near to what also the owner of a sole tradership would have to pay, so that seems to be an adequate total tax burden all in all. But now in a group you have again an entity in the middle, the parent company, and so you have to think about what happens if also that parent company has to pay taxes. Imagine the parent company now pays corporation tax too on their dividend and before they pass it on. In that case, you have corporation tax on the lowest level, corporation tax in the middle, again 15, and then income tax of the shareholder, and then it gets a bit too much. Then it would be 55, that's far higher than every other constellation would ever bring along. And imagine if it were a bigger group where you have more than one level below the parent company, it would even be 3 or 4 times corporation tax within the same group. And that is the explanation why one says, no, our system is laid out based on the idea that you pay once corporation tax and later the natural persons at the end of the chain pay their personal income tax on the dividend income. And so it would ruin the whole idea if in the middle also corporation tax would be taken again. And that is why on the levels in between, parent company, grandparent company, and so on, taxes are no longer taken, but paragraph 8b KStG exempts these dividends while they are going up their way through the group until they reach the final shareholders. That's the reason. The idea is otherwise the tax burden would become far too high, and by the way, otherwise no groups would constitute themselves anymore. It would be easy to avoid such a double or threefold taxation just by organizing all the companies in between as limited partnerships or the like. So one can show that generosity without losing money, because if you don't give that tax privilege in quotation marks, because it's not privilege, it's a decision which follows from the logic of the system. But if you were not willing to grant that exemption, well, it would not change the situation. You would not get the corporation tax 3 or 4 times, because then all the levels in between would be set up as limited partnerships or something like that, so that then also 3 or 4-fold taxation would be avoided in practice. Now that the participations of less than 10% are excluded from that treatment by 8b4, that's not really convincing, because also there you have that twofold taxation with corporation tax in the same sector, namely the corporation tax relevant sector. it's difficult to justify it. It is just made in order to get more money. The idea is if it's a small participation, a mere capital investment, then a group can't react by restructuring itself or the like, and we want the money. So that's really not fair and is in a certain way a breach of the logic of the system. Yeah. But many countries, by the way, do it this way and exempt small participations from the advantages which they normally grant to groups. The threshold from which onwards they give an exemption or a similar treatment varies from country to country. For example, sometimes you hear something about 25%, something the threshold, somewhere the threshold is 10%, as here in the German rule. In the OECD Model Convention, the OECD assumes in another context that for most states, at least from 25% onwards, the participation of a parent company in a subsidiary company should deserve a better treatment, and so on. Yeah. Now, you probably never get something positive without something negative being combined with that. And indeed, there is a general principle of German tax law and probably also of other tax legislations. If an income is tax-free, then also the expense which is spent to generate that income is not tax relevant. It's not deductible. That general principle can be found in German tax legislation in paragraph 3c(1) of the KStG. As far as income is tax-free, the expense correlated to it is not deductible. Now, consequently applied, that principle would mean that in cases where a company receives a tax-free dividend under 8b(1) KStG, all the expenses which that participation, so which the dividend reception costs, would be not deductible. Yeah. Seems to have a certain logic. Now, if we accept that principle, we soon end up in a catastrophe of bureaucratic efforts. Because now, if you take that principle literally here and think about the situation in the group, now you would have to go through all the expenses which the group has in its profit and loss statement and review all of them if a part of that expense was made or is related to a certain percentage of or to receiving the dividends from the participation. Let's start with the simple one. Has the participation been brought on credit base? Have you financed the cost of acquisition of the shares some years ago by a credit? If so, is there still interest being paid for that credit? If so, that interest amount would be related to the tax-free dividend income, and so that interest should be not deductible. Now that would be a simple one. Let's vary the situation in a more realistic way. When you bought that participation, that shares, probably you had some 4 billion or 4 million or whatever it was at hand in the firm. So you didn't need a credit. But these 4 million, whether really they're your own money, so did you have a 100% equity quote at that time, or was that 4 million not partly financed itself by credits which the firm had running at the time? If so, which part of that credit then referred to the 4 million which you then used to buy the participation, because then indirectly a part of your already existing credits had now been reused for financing the participation. And then it would be difficult to find out which part of the interest relates now to the shares and which not. You can even complicate things more. Has your managing director used a bit of his or her working time to think over the situation also of the group members? So Hmm. Hmm. Ah, I have a new strategy for subsidiary A. In that case, our managing director has used 2 minutes of his or her precious working time to improve the economic situation of the subsidiary. And so for the parent company, which pays him, that can only lead to dividend income. So these 2 or 3 minutes of his or her working time referred to tax-free income, so should be not deductible. Um, yeah. And how much time did the accountants of the firm spend to book the reception of the tax-free dividends? These minutes of their working time would lead to a non-deductible part of their salary. And so you can imagine that if you really followed that principle completely and strictly, you would probably go mad. Hmm? Because you would have to follow up the working time of the managing director, of the accountants. You would have to look into each invoice of a tax advisor, and so on and so on. It would be horrible. And so if you don't want to renounce on the whole principle, but you want to have it, yeah, dealt with in an agreeable way, then you must simplify things. So the German law introduced, that was an idea which they took over, I believe, from the Belgians. The German law just introduced a compulsory simplification of that non-deductibility expense problem. They just introduced a rule that 5% of the tax-free dividends are always taken as estimate for the amount of expense which will be not deductible, 8B5 sentence 1. So they said, we just don't care about the actual expense. We just estimate it always as 5% which of the dividend which is received. That estimate will be sometimes too high, in other years too low, but in the average over all the years, 5% of the dividends received will approximately, from our perspective, cover the non-deductible expense in a fair way. So in exchange, naturally, for using that 5% estimate, the actual expense which you had does not need to be checked anymore, even if you positively know that a bit of your expense or even a big amount of your expense is definitively related to generation of the dividend income. It plays no role anymore. The simplification is a simplification, so it always applies. Its only aim is to get rid of the task to review all your expenses which you actually had. So you can fully deduct the real actual expense. You don't have to check it anymore for its connection to the dividend income. If there is one, it doesn't matter. All the non-deductibility issues are dealt with completely and definitively by that annual 5% lump sum regulation. So even when you don't want to apply it, or even when you don't know of actual costs, the 5% rule always applies. So let's think about an example. We have a German Sond AG, seat and place of management in Kleve, and the Sond AG has a participation of 80% in the Freit AG and a participation of only 5% in the Dienst AG. Furthermore, there is also a participation of 20% in the Donnerst AG. From Freit AG, the Sond AG receives a dividend of 500,000 this year. From Dienst AG, it received a small dividend of only 3,000, and from Donnerst AG, a dividend 10,000. The acquisition of both, no, all the three participations already some years ago has been financed on credit. The interest expense which resulted from these loans was 100,000 for Fright AG, so for our shares which we hold in Fright AG, 10,000 Dienst AG and 4,000 Donnerst AG. How is this case to be treated, ladies and gentlemen? Well, that is just what we together now have to find out in order to practice these small rules of 8b. So let's think about it. As always, we try to begin at the beginning, so personal tax liability. Our taxpayer is evidently the Sond AG. That's a juridical person, so it's a case for the KStG. And we have unlimited tax liability because seat is in the inland. See paragraph 1, number 1 KStG. That's something what we already know from previous cases, but naturally it would be recommendable if you look it up in the Tax Act. Now let's think about the events, so about what more theoretically orientated people would call the objective tax liability. Okay, 2.0, the general introduction. What can we say under all circumstances without much thinking about the case? Well, the income has to be determined according to the rules of ESTG and KSTG. See paragraph 7.1, 7.2 and 8.1 KSTG. Here, all income is deemed to be income from business because it is a GmbH and it is unlimited tax liable. See paragraph 8 to KStG. So the tax base is the profit. That is 2 to number 1 ESTG, because this rule of the ESTG says exactly that. Now let's go on. The profit has to be determined by balance sheet and bookkeeping for 1 ESTG. That has to be based on the commercial balance sheet, so on the commercial accounting. See paragraph 5.1 ESTG. Deviations are only possible where tax law allows or even demands them. That's also 5.1. So the commercial profit is the starting point for the calculation profit. And now you see this was not really good sample case, because here the task data do not give that starting point. Shame, 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 shame. Because, well, it does not really matter for us when we just want to have an example concerning the rest here. Let's go to black probably. Yeah. So let's look to the first event here. Yeah. 2.1. So we have the dividend from Fried AG. That's 500,000. That's tax-free under paragraph 1, AB1, because the percentage is higher than 10%. Paragraph 8b4 KStG, which says it is taxable, does not apply. So taxable amount is 0. If plus 500,000 have been booked until now, correction would be minus 500,000. B. Connected with that is the correlated expense. 5% of 500,000 are deemed to be the non-deductible amount. See paragraph 8b5 sentence 1 KStG. So minus 25,000, that is the 5%, have to be eliminated from the tax profit and loss calculation. And how do you eliminate that? Just by crossing them out, or until now everything has been booked, even these minus 20,000, so erase them by plus 25,000 in the books. 2.2 dividend received from Dienst AG. That was only 3,000, not tax-free under paragraph 8b4, so regularly taxable 3,000. Until now, in commercial accounting, booked as plus 3,000, no correction needed. No application of paragraph 8b5 KStG, because not exempt. What's not tax-free does not entail the consequences of a tax exemption, naturally and clearly. Then we have the last thing, the Donnerstag AG. That's 10,000 euro. And the participation was 20%. Well, here paragraph 8b1 KStG applies again. Tax-free. So correct would be to bring this into account with an amount of 0. Until now, in commercial accounting, plus 10,000 have been booked. Reversal for tax purposes by deducting them again, because then you end up with the correct 0. B. Automatically connected with that is the 5% lump sum rule. Under 8b5 KStG sentence 1, 5% of 10,000, that is 500 euro, are deemed to be the non-deductible amount. So minus 500 expenses have to be eliminated from the profit and loss statement as non-deductible. And that is done by adding plus 500. So far, so good. Now we have for treatment of the actual expense. Let's say 100,000 interest for shares in Fried AG. Well, non-deductibility has already been coped with by the 8B5 lump sum rule. So the actual costs of minus 100,000 remain deductible. See 8B5 sentence 2, which says after sentence 1 has been applied, there is no need for any correction anymore. Then the 3C rule is suspended. So no correction. B, the expense of 10,000 related to the shares in Dienst AG. Well, these shares were taxable, so the corresponding expense is also taxable. It does not matter that we end up below zero. If in the long run it is expectable that we have an overall profit also here, a year where you have more costs than income, than revenue, also fully counts. And number 4, well, the 500 euro lump sum, see above, has again definitively done with the non-deductibility. So the actual expense here, 4,000, is fully deductible. No correction is made. The third entry would be adding it all up and calculating the tax. And that, ladies and gentlemen, unfortunately can't be done here because the other data, like the total profit, are missing. We had no starting value, so we can have no end value. But here you see which rules come into play. Okay, so that I think is enough for that example. Let's go back to our lecture and let's have a look on what else can surprise us still. Now, up to this moment, we have only spoken about the dividends from the inland. So naturally, we should also have a look to things which come from abroad, so foreign dividends. And the answer is surprisingly simple. Foreign companies, if they pay dividends to Germany, these dividends have to be treated exactly according to the same rules, so in the same way. 8B1 and 5 do not distinguish between inland dividends and dividends from abroad. The text of the law just speaks of dividends, so there is no distinction made between inland and dividends from abroad. The same applies to the 10% rule in 8B4. Also that applies to inland and dividends from abroad in the absolute same way. That even has an important legal background which you should be familiar with or become familiar with, because the background which forces us to treat dividends from the inland in the same way as dividends from abroad is the EU rules on free movement of capital. Under the European Union treaties, capital can be freely invested in or taken up from every other country. So cross-border investments shall not be hindered. That means if you are an EU citizen or an EU corporation, you have under the treaties the right to invest your capital in every other EU state, in every other state of the European Economic Area, and even unilaterally granted, even in third countries. So no restriction on the free movement of capital. And in the same way, the other way around, investors can, without restrictions, invest in Germany or any other EU state, irrespective if they come from the EU, an EEA state, or somewhere else from all over the world. That is laid down in Article 63 of the Treaty of the Functioning of the European Union, so that treaty which regulates the details of EU law. Then Article 65 clarifies that some distinctions are possible. And an important restriction is mentioned in the treaty, namely that EU and member states can continue to apply restrictions for the free movement of capital with regard to third states or third territories. All these restrictions, which have been in place already on the 31st of December 1993, can be still applied if they have been continuously applied since that date and have never been abolished. Now Germany has changed its corporation tax system completely in the year 2000, and so Germany can no longer invoke this standstill clause to justify its treatment of dividends from abroad, and that automatically required an equal treatment of dividends from everywhere. And by the way, as these rules are so important, we should naturally also take a glance on the original words of these rules, and that is why I and you too shall have a short glance into the consolidated version of the treaties on the EU. So here it is. That's the cover sheet. Official Journal of the European Union. The issue C for communications 326 from 2012. That gives us the consolidated versions of the existing EU treaties. And let's try to jump over to the consolidated version of the Treaty of the Functioning of the European Union, abbreviated TFEU. And there we are in need of Article 63 and the like. So let's look. Where are we here? Article 83. That's already too wide, too far. Here it is. Now this is the really relevant area. Capital and payments. Article 63. Here you see a small hint. It has been renumbered several times in the course of history. And so when the Treaty on the Functioning of the European Union was still named Treaty on the European Community, that it was Article 56. Within the framework of the provisions set out in this chapter, all restrictions on the movement of capital between member states and between member states and third countries shall be forbidden. Good. And also all restrictions on payments shall be prohibited, forbidden. Good. Now Article 64, that's the standstill clause, which I mentioned. The provisions of Article 63 shall be without prejudice, so they do not harm the application of rules to third countries of restrictions with regard to third countries, which exist on the 31st of December 1993 under national or union law. With regard to direct investment, so freedom of establishment, yes, because that is not granted to third countries, including real estate establishment, the provision of financial services is protected by the standstill clause, or the admission of securities to capital markets. So, not everything is protected by the standstill clause. You can see that. The Council can adopt measures on the movement of capital to or from third countries involving direct investment, and only the Council can unanimously, with 100%, adopt measures which constitute a step backwards, so new restrictions. Good. Article 65 says which restrictions are allowed, or what things are not restrictions which are forbidden. So 63 is without prejudice, so does not harm the right of member states, if it then exists, to apply the relevant provisions of their tax law, which distinguish between taxpayers who are not in the same situation with regard to their place of residence or with regard to the place where the capital is invested, but that right is limited. These measures shall never constitute a means of discrimination or disguised restriction. That means nothing else, that the Article 65 clause here just only clarifies the legal situation. It says what is a restriction and what is not. This exception or clarification has to be interpreted in a narrow sense under the jurisdiction of the European Court of Justice. An article or a paragraph 4 has been added sometime later. If there are no measures taken unanimously by the Council, which introduces new restrictions, the Commission can adopt a decision which states that restrictive tax measures adopted by a member state concerning one or more third countries are to be considered compatible with the treaty, insofar as they are justified by one of the objectives of the Union and compatible with the proper functioning of the internal market. So exceptions would be possible, but only if they can be justified in court, and then they would be attacked probably, and the court shall act unanimously. So with the Council shall act unanimously, so with 100% majority. So that's rather that's rather hard to achieve. So here you see the background is clear. You are not allowed to bring forward any restrictions of the free movement of capital. That also clearly extends to the field of taxation. And that means if you were willing to treat dividends differently in tax law, you would probably directly end up with difficulties, because then there would be here a conflict with Article 63 to 66, which says, no, you have to renounce on every obstacle and every discrimination concerning investment in third states. And that is why Germany, when the new system was introduced, clearly gave up and said it makes no sense, just treat it all alike, and here we have a clear and unproblematic system. Now, in all cases where dividends come from abroad, tax rules which would treat these dividends different from inland dividends could only be justified if the situations would not be comparable, because EU law says no restriction. That means no discrimination between inland and foreign investment. And naturally, the discrimination is only given if things in a comparable situation are treated differently. So you could talk yourself out of the problem if you could show that the situation in both cases is not comparable. There, the European Court of Justice has sometimes accepted the argument that if a foreign state does not take part in an exchange of information with the fiscal office of your state, then the situation is not fully comparable with regard to what matters for taxation. But where such an exchange exists, it is difficult to bring forward any justification for a different treatment. Or you could find another compelling justification for the differentiation between inland and foreign income in case of a dividend that has never been successfully possible for somebody during the last, I believe, 20 years. So it's highly implausible that somebody ever comes up with such an argument, and that explains why Germany just said, okay, let's make things clear. We grant equal treatment for foreign dividends and inland dividends, no matter what. So then we are on the safe side from the perspective of EU law, and we take the same amount of money from both, so no problem. Good. Another aspect has to be dealt with still. Up to now, we have only talked about the dividends which you get. Now, let's think about the dividends. Not about the dividends, but selling the underlying shares. And here, German law is relatively clear. Again, German law says 8b1, dividends are tax-free. 8b2, if a corporation sells these shares, the gain from selling the shares is also tax-free. That deserves, I think, a look into the Tax Act again, and so let's have that look, ladies and gentlemen. Yeah, here we have it, 8b2 KStG. For the computation of the taxable income, gains from the alienation, so from giving away, from selling of a share in a corporation or association of persons whose payments lead to revenue as described in 21 number 1 to 9 or 10. Let me translate. When you compute the taxable income, then gains from selling shares which lead to dividends in the hands, also which can pay out dividends in the hand of the holder, are left unconsidered. That's again that nice, polite way to avoid the brutal word are tax-free. The gain is now defined. The gain from the alienation, so sale of a share, is that amount by which the price or any value replacing that value exceeds, after deduction of the costs of selling, the value which is relevant for the computation of the tax base, so tax book value, at the moment of the sale. Here you see, that's poetry, ladies and gentlemen. One could probably have put it more simple, in a more simple way, but evidently I think, okay, who is willing to open a tax act voluntarily should also be able to, to tolerate some complicated language. And indeed, I think we could do this. Let's revert to our slides and go on. The reason for that tax exemption is an economic one, because economy says the price which an acquirer, which is who or which in case of a company, who or which is reasonable. The price which such an acquirer pays for the shares will be nothing else than the discounted value of all the expected future dividends which are expected to flow from that share in the future. So, selling the share is nothing else than a different way of collecting all the future dividends. And now, If collecting the dividends in the usual way, waiting and taking them year after year, is tax-free, an alternative way to collect them should also be treated in the same way. Otherwise, you distort the behavior of people in the markets. For example, if dividends are tax-free but shares gains are not, then probably people would never be willing to sell shares. They would just wait and collect the incoming dividends. And if they need money, they'd never sell the shares, but would take up a credit and pay it off with the tax-free dividends or things like that. So equal treatment seems to be a good idea because both alternatives are economically basically the same thing. So also selling the shares should be tax-free. Yeah, so 8b2 orders exactly that. Gains from the alienation of shares are tax-free. And now 8b2 sentence 2 also gives you the computation, the price minus the cost of the sale, naturally only as far as the seller has to bear them, not if the buyer paid for the notary or so. Minus the book value of the shares, and that is the gain which is tax-free. Now, there is something to notice carefully. The first thing is a gain can also be negative. Imagine you bought shares for an enormous amount, let's say 1 million, and then the company nearly went bankrupt. Now it has still a value of 100,000 only. So you get a price of 100,000. Let's say cost of sale are 0 and your book value is 1 million. Then you make a loss of 900,000. And now, surprise, a gain is also a gain if it is a negative gain. So also that is tax-free. That is clarified in 8b3, but it's also directly following from 8b2. The gain is tax-free. That also means a loss would also be tax-free, so not relevant for tax, not deductible. Now, if you are in such a situation, you could use a clever trick. You could avoid a loss from a sale if 1 minute before you sell, you depreciate, you make an impairment on the book value and lower the book value down to the market value, because then you have an expense from an impairment. And if you look with a very formal attitude to what you did now, you could say this is now a loss from an impairment and not a loss from selling. Naturally, that can't be allowed, because imagine you have shares with a book value of 1 million. Now, if you sell them, that leads to a loss. So now you depreciate them instead by 900,000 to their present market value of 100,000. And then the subsequent sale will be market value 100,000 minus present book value 100,000 plus minus 0. That would be too easy to avoid a loss, and so naturally, as the people in the ministry are not completely stupid, they have foreseen that alternative and naturally have added into the law a small rule which says naturally all expense connected with these shares, especially all incidents which lower the profit and are connected with the shares, are also non-deductible expense. You don't need to wait until you sell. Also, an impairment would be not taxable. And after a while, even another clever trick turned out. Because, well, if you just make an impairment and depreciate the shares to a lower value, that's expense, not deductible. Now somebody came to an idea to combine two kinds of investment in a clever way, so that gains would always arise in the tax-free shares and losses would mostly hit other areas. And that trick goes as follows. First, set up a company and now establish or equip that company with a minimum of equity, let's say 25,000 euro. Now, if the company needs more, then you give all the rest as a credit only. And now, what would be the effect if the rules are applied in the normal way? Well, if the company has success, then the value of the company goes up, not the value of your credit repayment claim, because a credit is always paid back at the repayment amount, so 975,000 euro. So if now the value of your company goes up by millions, then the only thing which increases in value is the value of the shares, and you can sell them tax-free. Now, on the other hand, there is another drastic alternative. The company fails bankrupt. Then the shares become worthless. You lose 25,000 euro cost of acquisition from the shares. That loss is non-deductible. And probably you lose your credit repayment claim. So you have an additional loss from 975,000 euro. And now you could say this is not a loss from selling a share. So you could, under normal rules, offset that against the tax base. That would be a really great tax saving model, because whenever you have success, it's tax-free, and whenever it goes wrong, you can lower your tax base. And naturally, you can imagine, ladies and gentlemen, that when somebody came to that idea, fiscal officers naturally began to talk about it, and then quickly afterwards there was a new sentence in the law which said, okay, no, we are not going to have ourselves tricked in this simple way, because that would be really paradise for a parent company. And so an additional rule was introduced into 8b3, and this rule begins in sentence 3 of 8b3, which says reductions of the profit which are connected to a share named in paragraph 2 may not be taken into account for the calculation of the taxable income. So here's the general principle: any loss, income, or expense in connection with such tax-free shares cannot be deducted. And then it goes on, sentence 4, the reductions of the profit named in sentence 3 also include reductions of the profit which happen in connection with a loan, a credit, given to the company, or in connection with the loss of collaterals given in connection with such loans taken by the company, if the loan or the collateral has been given by a shareholder who owns or owned directly or indirectly more than 1/4 of the share capital of the company to which the loan was given. So losing a credit claim if you are a shareholder who has more than 25% also leads to non-deductible expense. In addition to what I just mentioned now, there is a far more general rule which always is in 8b3 and accompanies the cases of 8b2, so that a share is sold tax-free. That is also a 5% lump sum rule for non-deductible costs in combination with the share or in connection with the share, because 8b3 orders that 5% of the gain made from a sale are to be treated as non-deductible expense, which is connected to tax-free income. Now, these 5%, to clarify that, are not eliminated because one aims at elimination of the costs of the sale, because the costs of the sale are already deducted from the gain. These 5% are an additional equivalent for the deductibility of the actual current costs in relation to the participation during that time when you held the shares. That's a bit difficult to understand. Let me explain. As you remember, the actual costs of a participation of shares could be deducted. The interest, the wage for the 2 minutes during which the managing director thought about improving the situation of the subsidiary companies and all that. That was always estimated with 5% of the dividends. And now you can play a very, very clever trick, just pay yourself no dividends. In that case, everything's very, very fine because 5% of a dividend of 0, which you get, is a lump sum of 5% of 0, namely 0. And yeah, by that, or apart from that, you can fully deduct your actual current cost. So that would be a clever trick. You can deduct all your costs in relation to the participation, 8b5 sentence 2, and the compensation which the law has established for that, the 5%, is a 0 amount year after year after year. So that would be a bit unfair. It's a clever tax saving model. Also, that must be countered by a clever legislation. But the question is how, ladies and gentlemen? And here that 5% rule in 8b3 comes into play. If you later sell the shares, 5% of the gain are taken. And now, why does that make sense? Imagine this. You have a subsidiary. You establish that with an equity of 100,000 euros, so your cost of acquisition for your shares is 100,000. Now next year, your subsidiary makes a profit of 50,000. You can either pay it out, then you have a lump sum of 5%. That would be 2,500 as non-deductible costs. Now you are clever. You want to avoid that, so you say, we don't pay a dividend. So we just let the money stay inside the company. Now the retained earnings go up by 50,000. What does that mean for the market value of your shares? They go up at least to 150,000. So clever. No lump sum this year. But on the other hand, if in the future, at which time ever, you sell that share now, the market value has at least increased by these plus 50,000. And so, if the legislation now says, if later you sell, then 5% of all the gains will be non-deductible. That means whenever you store money in the retained earnings, instead of distributing them as dividends, that automatically pushes up correspondingly your future gain from selling that share. And so as 5% are also taken as a lump sum from the gain from selling the share, you can now no longer escape these 5% non-deductibility amounts. Because if you don't pay immediately 5% on a dividend, you will pay these 5% on a correspondingly higher gain at the end of your holding the shares. So whatever you do, you can't escape the 5% in the long run, and that is what makes that 5% lump sum from a gain necessary. Yeah. Okay. By the way, when it comes to citing the references, keep these two 5% rules apart, please. The current dividend 5% rule is 8b5, so 5% are usually in paragraph 5. Only in cases where you sell the shares, then the 5% lump sum rule can be found in 8b3, near the 8b2 rule for selling shares. And Another curious fact in combination or in connection with selling shares is dividends are only tax-free if you hold a participation of at least 10%. When it comes to selling shares, that 10% rule does not apply. 8b4 only says 8b1 is not applied, so the dividend exemption rule is not applied if you don't hold at least 10%. Paragraph 2, the tax exemption for selling shares is not mentioned there. That means you could even sell a single share or a 5% participation, and that would be tax-free. By the way, in that case, that 5% lump sum for current cost would also be applicable, because 8b3 makes no difference. Although when the current dividends would be taxable, in case of a 5% share or single share, that would be the case, then the 5% non-deductibility rule is not justified, but nobody goes to court because of that, because nobody wants to remind Parliament that they have forgotten also to deny tax exemption for selling shares with a low participation. And so everybody is happy with the situation as it is. Dividends are tax-free only if you hold 10% at least, whereas selling shares is always taxable if you are a juridical person under 8b2. Yeah. And now, ladies and gentlemen, at the end of a small lecture, we can naturally again think about some testing case to sum up what we have learned. So here's the case example. AG has seat and place of management in Germany. The last accounting period was identical with the calendar year. It ended with a commercial profit of 790,500. And during the computation of that figure, the following events were taken into account: corporation tax payments, trade tax payments, a dividend was received from an Irish law limited, 30% participation were in play, then a credit which was taken up to finance that acquisition some years ago caused expense of 40,000 interests. A dividend came from a 5% holding in a German GmbH, and a dividend for 50,000 was received from a German GmbH where one had a major participation, let's say 20% or so, and the shares mentioned under 4 was sold. A payment of 60,000 was made to the members of the supervisory board, and a donation was made to a political party. And the final question is, solve the case, please. And that is what we have to do just now, just to finish today's lecture. So let's begin again. Personal tax liability. You see. Example, AG is a juridical person, so KStG applies. And let me correct that typing mistake because it's a bit awkward. Okay. Now we have unlimited tax liability under 1.1 KStG because it is an AG and seat is in the inland. So number 2, we have now the objective tax liability, or the analysis of liability events. 2.0 would be a general introduction, which is, ladies and gentlemen, not surprising, nearly always the same. The income has to be determined according to ESTG and KStG rules. See paragraphs 7.1, 7.2, and 8.1 KStG. All income is deemed to be income from business, C paragraph 8, to KStG. So the tax base is the profit, C paragraph 2, to number 1 KStG, to be determined by balance sheet, paragraph 4, 1 KStG. And that is to be based on commercial accounting. I forgot something. The complete profit is deemed to have been earned on the date of the closing balance sheet, paragraph 7.4 KStG, so end of the current year here. The profit calculation is to be based on commercial accounting, paragraph 5.1 KStG. So our deviations are only possible if tax law requires or allows them. See again, paragraph 5.1 KStG, the so-called principle of Maßgeblichkeit. So the commercial profit of 790,500 euro is the starting point for our calculation of the tax profit. Now 2.1, corporation tax expense, clear case. 130,000 not deductible under paragraph 10 number 2 KStG, until now booked as expense with minus 130,000, so correction by adding back the 130,000. 2.2, trade tax expense, 140,000 euro not deductible under paragraph 4, 5b KStG. Until now booked in the commercial accounting with minus 140,000, so correction needed I plus 140,000, because if it is not deductible, you should have booked a 0. You had booked minus 140,000, so you have to turn that minus 140,000 back into a 0 by adding that back. We see in reception of dividend 100,000, 30%. The revenue of 100,000 is tax-free under paragraph 8b1 KStG, 8b4 KStG, because the participation is higher than 10%. Booked until now as revenue with plus 100,000, so correction by minus 100,000. B, the 5% non-deductible expense. Paragraph 8b5 KStG. That means minus 5,000 have to be eliminated from the expense. So done by adding plus 5,000 back. Now 2.4, credit interest is completely deductible because of paragraph 8b5 sentence 2 KStG, which says the actual costs remain deductible in return or in exchange for that 5% rule, and they have been deducted under commercial law. so no adjustment needed. Okay. Now let's go on to number 5. 2.5. Dividend from 5% holding. Revenue is fully taxable. See paragraph 8b4 KStG, which says the tax exemption does not apply if you hold less than 10%. Until now, plus 5,000, correct, is also plus 5,000, so no correction needed in the commercial profit. 2.6, the dividend of 50,000 from 20% participation. Again, probably we are boring you, but the revenue is tax-free under paragraph 8b1 plus 4 KStG because more than 10% of the shares. That means booked until now have been plus 50,000. Correct would be 0 taxable. So adjustment minus 50,000. Now let's come to the 5% non-deductibility. So minus 2,500 have to be eliminated from the expense of the firm. See paragraph 8b5 KStG. So the consequences add up 2,500 euro again. 2.7. It does play no role that no real costs were incurred, because the idea is, okay, perhaps this year we have a low amount of costs connected with that shares, but in future years we will have correspondingly more, and over all the years that will be roughly okay. So selling the shares of the 5% participation mentioned under 4, under 5. Yeah. So it should be under 5. Sorry, that's a typing mistake. We have now, this is tax-free under paragraph 8b2 KStG. 40,000 tax-free gain. But we automatically also have a B consequence. 5% of the gain is not deductible. And that means 5% of 40,000, that is 2,000, have to be eliminated from the firm's expense. And that can be done by adding plus 2,000. And by the way, I forgot naturally, which adjustment does that need here? 4,000 tax-free gain means taxable amount is 0, booked until now was a revenue of 40,000, because naturally in the books of the commercial accounting you will have these 40,000, so minus 40,000 will be the necessary adjustment to make the transition from commercial accounting to tax accounting, or to taxable profit. 2.8, payments to the supervisory board. Half of it is non-deductible. You remember that paragraph 10 number 4 KStG. So only minus 30,000 instead of minus 60,000 shall be taken into account. Until now, minus 60,000 were booked. So plus 30,000 adjustment, and B, payments to the managers. No special rule applies, so business expense for 4 KStG fully deductible. That has been also done under commercial law, because naturally the salary would be booked as expense, so no adjustment necessary. Donation to the party, not deductible under no circumstances under 4.6 KStG, so 0 for tax. Until now, commercial accounting, there you have naturally accounted for the money by booking it as expense, so correction plus 10,000. And now number 3, adding it all up and calculating the tax. We have a starting point of 79,500. Then, because of event number 1, plus 130,000 come on top. Then number 2 plus 140,000 come on top. Then because of number 3, 100,000 are deducted. Because of number 3 again, plus 5,000 are added up. Then number 4 comes, and we have no adjustment there. Number 5, no adjustment there. It goes on, and we need a new page. Because of number 6, we have minus 50,000. And because of number 6, we should also have plus 2,500. Let me look it up if I have forgotten that or not. We had it. Thanks to God. Number 7, the shares which were sold minus 40,000 are eliminated from the profit, but you have again the lump sum of 2,000. Then we have, due to event number 8, we have plus 30,000, and under 9 we have plus 10,000 to be added back. And if we add all that, ladies and gentlemen, suspense is rising in an intolerable way. Let's have a look to a calculator and try to calculate. And that seems to end up with, I hope at least that's correct, with 924,000 euro. Then the tax would be 15%. I hope it's correct. So that would lead to 138,600 euro as tax. By the way, minus prepayment made 130,000. So remaining liability for corporation tax final payment would be 8,600, and for this under commercial law you would have still to make a provision. And ladies and gentlemen, that shall really be enough for today. Thank you very much for watching. I hope you are now a bit familiar with the rules which a corporation can follow when it comes to dividends and selling shares in other companies. And yeah, that gives us a good feeling until we meet each other again next time and have to talk about the next small details. Thank you very much for watching, and hope to see you back soon here on the same channel. Au revoir. Where can I press that stop button? Here.